It is Wednesday, February 3rd, 2021, and today I want to talk a little bit more about some of the warning signs that I'm looking at in the chart for basically predicting a stock market crash. Now, I am not very, I wouldn't say these are definite warning signs, but there's some things that I've noticed from previous stock market or from the previous stock market crash back in February to March that I think it would be good to look out for in the stock market to see if some of these signs are coming back and warning us that another crash may be coming. My long-term thesis is that yes, there is another crash, but I don't know the timing of that crash. So you can see here, previously I sort of had the timeline for the crash in this range, but that was not really based on anything other than the fact that the last time we crashed, we jumped over this long-term trend line, which goes back to, I guess, really kind of the 2008 timeline. It doesn't exactly intersect with that, but it intersects a little bit better with more recent points in time. So the March crash, the February to March 2020 crash, jumped over this trend line. The SPY jumped over the trend line and then crashed. But there's some more subtle details I want to look at in seeing, I guess, patterns that I noticed for the last crash. So I'm going to go ahead and start with the SPY and some of the things I noticed. So you can see since this sort of 2018 flash crash, the market went up, had corrections along the way, many corrections, but then it just stabilized and went straight up with only what I would say are false breakdowns. I would say a correction is more like something like this, where it's 5, 10, 15, 20% of a drawdown. You can see along the way we've had, anywhere between 5 and 10% drawdowns in the market. But then these just sort of stopped. We had like a 2% correction. And the only reason I say this is a correction, maybe I wouldn't consider it a correction. We have a main trend line up here, and then we have sort of a secondary trend line which provides the bound for these corrections that occur. So you can see most of the time we spent in this trend channel up here, but occasionally dropped below and retested the lower trend channel. So you could argue that this is a false breakdown of the main trend channel, but it was sort of bounded by the lower trend channel. So this happened once, twice, 3 times, and the third time that this happened, now this is what's important, is that there was more of a significant move. I guess this was a 3 to 3.5% move down to the downside, and then there was a recovery, but it didn't recover above the trend line that it had spent most of the time above. It basically did some back tests, or crawled along that trend line, and then that's where it failed. The other thing, so that's important, that there's a breakdown below the trend line and it does not recover. The other thing to notice is that the RSI, well, we started to see some negative divergence at first, going back maybe right here. Very slight negative divergence. I don't know if it goes back further than that. Not really. At least it's not very clear that that occurred. So the first negative divergence occurred, I guess, well, we had a peak in December 27th. So you started seeing it January 17th. So that's where you started seeing weakness. And then we had a correction right after that. We had a peak and then a correction or false breakdown, whichever you want to call it. I'd say this is almost more of a, you could argue it's a correction because it did move back down to a previous level of support. But then we recovered. We didn't go sideways for a while. We just straight up we tried to recover. But once this happened, the negative divergence was pretty extreme. Like that's really significant negative divergence. So there's two warning signs, really big negative divergence. And when I say negative divergence, I mean we have a higher high on the price action and a lower high on the RSI. And so the fact that we never recovered and the fact that we had negative divergence, those were two big warning signs. Now let's see if we have any of those two showing up on our SPY chart now. Let me get rid of these first. Okay, so the first thing you notice is that we have had less time in this sort of upward trend since the last correction. Like we've had this region where we went sideways from basically September to November, and then we finally broke out. And we've been climbing up this trend. I guess the first thing to notice is that the trend channel is a lot less well defined. We have maybe a main trend line here and a secondary trend line down here. The upper trend line is also not super well defined, but this is what it looks like right now. And you can see we broke down below this lower trend line in this latest, I don't know if you want to call it a correction or a false breakdown, but we broke down and then we recovered both trend lines. And I don't really see, I guess maybe you could say, okay, so maybe you can make an argument that this could also be a main trend line, but it's not very well defined. So I would not be surprised if neither of these two trend lines are respected. But what we're looking for here is a breakdown and a failure to recover. We can see in all previous cases, the trend has, it successfully recovered. So if we fail to recover this level up here, that may be a warning sign, but it's not as significant as previous times. The other thing to watch out for is that we started getting negative divergence on this chart. And I would say you could argue that we had negative divergence since way back here in September, but I don't like that. The reason I don't like that is because we had a correction after you started to see that. Well, did we have a correction? Yeah, I mean, we made a high up here, and then we broke down and went sideways for a while. So even though this is sort of the peak for a while of the trend, we broke down below that trend, or below sort of the shorter term trend, went sideways for a while to sort of burn off that momentum, and then we started a new trend. So I'm really just looking at this trend right here for the divergence. Maybe it's important to take this into consideration. I'm just taking this into consideration for now. So we have slight negative divergence, depending on where this peak is on this chart, or on this price action, we may see a big downturn in the RSI trend, which would be another, would be a warning sign. So right now, it's not certain, but it may be something to watch out for, that two of those warning signs that we saw in February of last year are playing out. All right. So the next thing to look at is the US 10-year yield. All right. I think we turn this off logarithmic. Okay, so February 20th, let me go back to, actually, let me open up a new window so that I could quickly flip back and forth between these. All right. So we're looking at February 20th, 2020 as a significant date. The reason this is significant is because it was the last day before we broke trend for the second time on the SPY. So zooming in a little bit, it was basically the last day of the bull market. So go to the 10-year yield. What happens on February 20th? Well, to start with, we were in the 10-year yield. We had come down for a while, and then from September 2019 to basically January 2020, we had moved into a rising wedge, or just an uptrend on the 10-year yield. And we have support here, which kind of goes back for a while. I would say that's a fairly significant level of support because we've tagged it a number of times in the past. It's not super precise, so you could argue that, that's not a great level to draw out. But then we broke this trend and we tagged that support level, and that's why I think it's important, is because it was a level where we've tagged multiple times, once in August, once in October, and then another time after we broke trend. So we tapped that level, had a small uptrend, and then broke down. And when did we break down? The day after February 20th. So the first day we broke down on a major support, that was when the market turned down. And the US 10-year yield, I'm not exactly sure how the price action of the 10-year yield works. I mean, I wouldn't even say it's price action. These are interest rates. This is just the percentage yield of a 10-year bond. And so why does the rate fall? I guess that's the question. And I think the reason is if people are rushing into bonds, that could be one reason. So the more you buy up the bonds, the more the interest rate is pushed down. I think that's how it works. Not 100% sure. But that's my assumption for now. Anyways, so we have this uptrend. We break down out of that trend, and then we break down below the support that was kind of established by that trend being created. So then the interest rates basically shot to the floor, went sideways for a while, and then once we started having this, once the recovery was well established, I guess around August of last year, we've created a pretty significant level of support right around the 0.63% level. There's another level of support down here about 0.5%, but I think the 0.63% is more valid. So I think something to watch out for is we're in an uptrend. when we break that trend, that's a warning sign. When we break below this 0.63 level, that could be a massive warning sign, because I think that means people are rushing into bonds at an even higher rate. So that is the second thing to think about, or to take into consideration, is when do we break this uptrend? And one thing to notice is I don't have this on log scale. This 10-year yield chart does not. I think the linear behavior is already, or the logarithmic behavior is already built into the chart. Or, well, because it's a percentage chart rather than a price chart, I think turning a normal chart into log scale basically makes percentages more linear. I am not giving a good explanation, but something happens to where you don't need to use log scale for charting the US 10-year yield. Okay, so DXY, US dollar index. We're going back to February 20th. That's the major inflection point. And you can see what happens here. We were sort of in a long-term uptrend. This I'm not paying too much attention to. We were, well, I guess it is good to pay attention to this. Basically, we had been in an uptrend in the dollar for weeks. How much time? Basically 17 days going up to the turning point. And the dollar turned around and it just started dropping as the crash started. So a major reversal in the dollar chart. And I guess there's two significant areas where this reversal occurred. One was in this long-term uptrend since 2017. The other point, which I think is probably more important, is that it hit the $100 level. You can see the US dollar has been above that level. Let's go to the weekly chart. Above that $100 level a couple times in the past, but the $100 level, I have this at 99.99, but it's about $100. Where was it a significant level? I mean, it's sort of a level of significant level here, or, you know, in several times in the past. There's reactions at the $100 level. So we could say this is a major level because every time we go around $100, we meander around there for a while. So let's go back to here, back to the daily chart. So we hit the $100 level, and then it just gets rejected hard and free falls until essentially the bottom of the crash. I'm not exactly sure when the bottom of the crash was. We can find out here, March 23rd. Whereas this, what was March 23rd on this chart? Interestingly enough, the top of the dollar was, like, the peak was on March 23rd. So it free falled, then got turned around, and then when the crash was basically at a reversal point, that's when we had a turnaround on the US dollar. But I guess the important thing to note is that we got rejected at a major level of support on the DXY. That was the beginning of the crash. So where are we now on the DXY? We have been in a downtrend. We broke out. And the most significant level of resistance I see is this 92.29 or 92.21 level. You can see it was definitely respected here several times, but further back we've got reaction points along it. So for many years we've had reaction points at that level. So I think it's a significant level of resistance. So we have this breakout, and so if this keeps going and then gets rejected up here, that may be a warning sign. Now I would say this has to intersect with several other warning signs. But if we get a rejection here, see a couple of days of down of the dollar going down, along with the stock market going down, along with the I actually don't remember, along with the U.S. 10-year yield, I guess, breaking below support. If we get coincidence of all those three things happening, that could be a major sign for the market in general. Okay, so next thing I want to look at is the VIX. This is quite interesting because what am I looking at here? Okay, so what happens right before the crash? Right before the crash, we had a spike in the VIX in August 2019. What happened in August 2019? We basically had a market correction. Why this? Well, yeah, I mean, this was basically the most recent market correction before the crash. So, the VIX spikes, and then, it meanders down, spikes again, meanders down, spikes again, and it continues that basically as each time we have a downturn in the market, the VIX spikes. But what's important is that we have a downtrend in those spikes in the VIX. And what happens at the most recent spike before the crash? We break through that downtrend line. So even though, this is where we're looking at. Even though this was not a more significant correction, this was only a 3.3% correction, whereas the August 2019 correction was like more than double that if you go all the way from the top to the bottom. So more than double that. Well, I guess this was the most significant correction since that, and that's why we broke through this downtrend line, because you can see that every time we had a market turn, let's just say September 2019, that's when it spiked, and then again at December 2019, that was about this correction. So every time we had, I should just call it downturn, not correction, every time we had a downturn or red days in the market, the VIX had spikes, but they were more mild than the previous one. So this is the first significant spike, or the most significant spike since this. So I guess that makes sense that it would break out of this trend channel, or trend, I guess this downward trend. And you can see that it spikes and then it wanders downwards, but it doesn't get to the lows before the crash occurs. So that may be another thing to look at. What do we have now? We've had this crash here, and then we've had basically a downward trend in the VIX since then. Something probably more like this would be more accurate, but I guess since the first major correction of the crash, that's really what you want to look at. But there's a reaction point back here, so you may or may not include that. So when was the first correction since the crash? July, June, July. So about this time was the first big correction. And then ever since then, even though this was a more significant correction back in November, or sorry, I guess it caused a bigger, what actually did happen there? October 30th was the peak. So, okay, so it was this correction. So I'm not sure why the VIX spiked in the way it did. But the point is that since the first major correction in the market, since this March crash last year, we've had a VIX that has continually trended downwards. We've never broken the first correction high or the previous correction high with the next correction high. So if we do break this, that's probably something to watch out for. Now, there may be different ways to draw this, and this may be, you know, a bad indicator for a market crash, because I mean, you can see we've had a downtrend here where we've had multiple spikes, but I guess the important thing is that, or the analogy or the analog between this and this is that we found a base of support at the bottom of the VIX, which we have not broken through. And that's what's happening here. So I think this trend may be a valid indicator. It's at least something to watch out for. If we break above this trend line, it means that people are panicking more or buying more put to protection than any time since the crash. Well, not more put protection, but they have broken the trend of how much put protection they're buying. So the momentum shift in the put protection buying has changed. That's really what it's saying. So that is another thing to look for. Now, in this most recent correction, that did not happen. We did not break trend. Unless you want to say, okay, our trend, yeah, I don't see any other way to draw it because this correction back here was significant. And maybe we could say that this is the trend line because it more closely follows this reaction point. So yeah, I wouldn't say we broke this trend line any way you draw it. But that is something to look for. Is a break of the trend and then a failure to fall back to this level of support. So based on that sort of overall analysis, it looks to me like none of these warning signs, except for possibly the one I mentioned back here where we have broken trend and failure to recover with lower RSI, none of these warning signs seem to be playing out. That doesn't mean they won't play out in the next few days to weeks, but so far none of them have played out. And so my expectation is that either we have a normal market correction, you know, this false breakdown was like a fake out breakdown and the real breakdown is coming and maybe we have a real market correction, or we just continue up this trend for a long time and 6 months down the road, that's when the warning signs are broken, or that's when we start to see these warning signs play out and the crash happens. So I think the market is bullish for a while longer. I think my original timeline for, well, this megaphone pattern, it may be broken in the next couple of weeks and this may be invalidated. this sort of prediction back here. Now, I didn't expect it to play out, but as you see things, I think it's important to respect them and be aware of them, I guess. Be aware of them and take them into account when trading. At least that is what I'm doing. Maybe it causes you to be overly cautious. Maybe it causes you to do irrational things because they are completely wrong warning signs, basically crying wolf when there is none. But, we live in or the market right now, I think it's super fragile. So we need to take that into account. It's booming, but it's fragile. So that's it for this video. Thanks for watching. I'll see you guys next time.